This episode was originally a live conversation recorded at the Swisspreneur Growth Syndicate Demo Day 2024.
As a founder, you should not care about valuation of your company. When you are looking for money, what you should care is what will be the potential value of your company at exit, and when to make the calculation backwards.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Silvan.
Good evening, everyone. A very well welcome to the first Syndicate Growth Demo Day. It's my pleasure to host you here in the evening. My name is Silvan. I'm the host of the Swisspreneur podcast. And it's the first time that we host this format. We started with some pre-seed and seed investments about 2.5 years ago, and then saw that there's a bigger need for growth funding. And that's exactly why we launched this new format here as a first test. And we're eager to have all of you here and hear your feedback about how you like it. With we, it's Swisspreneur and NZZ Connect, the company behind the Swiss Economic Forum, for example, and many other amazing conferences that put this evening together with our friends here at Google and also Leva as a platform partner in the venture capital operating system. We have 4 top caliber guests sitting right here and just getting ready to come on stage. I'll introduce you one by one. Let's start first with Diego Braguglia, the managing partner at VI Partners. Please come on stage, Diego. Very well welcome. You can take the green seat. Then the second guest tonight is the general partner at Red Alpine, Harald Nieder. Welcome. Kevin Baxpehler from Reimagine Ventures, also joining us here, the managing partner. Welcome, Kevin. Thank you for being here. And last but not least, of course, we also have Verve Ventures here, the Chief Investment Officer, Mike Hobmeier. Very well welcome, Mike. Thank you all for taking the time and for being here today. Since we have growth startups pitching, but also startups in the audience, probably entering or already being in that stage, we really want to talk about growth funding and what startups need to consider. Before we go there, I want to just do a quick introduction question with each single one of you. The first one for you, Diego. You basically invest in Swiss biotech and medtech startups. You've done that for more than 20 years. Why is that the right focus for you?
I think when we started, it was a good idea. Now I don't know whether it's still a good idea. But I think if you look, Switzerland is a country in which we are not the country of banking, we are the country of pharma and medical devices. And basically, in order to get good substrate, you need 3 things. You need money. We have a lot, maybe not too much invested in healthcare or in VC. You need very, very good industries. And you need excellent universities and hospitals. And we have all of this in Switzerland. So which started back in the 2000, I think what it's increased. Also when we started back in 2002, 2003, so we were not speaking on SIS software. So we were speaking about IT telecom software. It's not that. So, Internet of Things was very, very embryonic. But it was the time in which really also the university was starting to educate students in that space. Was not the case with the healthcare industry. So we always have been very, very good at world level to produce excellent discoveries. The highest density of Nobel Prize in healthcare in Switzerland. And this it was what it happened. Now also we are leveraging up with the IT and software SIS, but still remains a very, very good country to invest in healthcare.
You make it sound so logical and so easy. It comes natural to you in that sense.
Well, we belong to the dinos of this industry since we survived a couple of crises. But I think we followed that path, and it was incredibly to see how the Switzerland ecosystem, also the healthcare ecosystem, was able to cope with all the big challenges and defeats of the technologies and the healthcare and the industry over the last 20 years. And we are still on the top of it. So nothing to hide and just to invite what is happening in the US or outside of Switzerland.
Fantastic. Kevin, switching over to you. Before you joined the VC world, you were actually working on Wall Street. And I was just wondering, why is the VC life better suited for you?
It's a lot easier. No, I'm just kidding. First of all, thank you for having me. It's a pleasure to be here. It's true that I started off my career on Wall Street on the sell side and on the advisory business as an investment banker. And I wanted to have more skin in the game. So actually, before I became a VC, I was a founder. So I founded a couple of companies, and that was a really great experience. And eventually that led me to angel investing, which led me to become a VC. Again, a little bit easier than being a founder and having a bit more life balance, but yet still having skin in the game. So that was my objective and goal, and that's how I became a VC.
I love the skin in the game part, really important. Harald, if you look at your LinkedIn profile through your role as general partner at Red Alpine, you're a board member at least 13 startups. And despite having an investment there, I assume, what is sort of the red line that connects all of them?
Oh, that's a good question. I think what ideally connects all of them is really great teams, because this is what we're looking for. We are a multi-stage venture capital fund, but be it early stage or be it growth stage, what we're discussing today, I think it's really the great teams, but we are also very much driven by technology and product. So this has always been a very central point for us. We are really after companies that are differentiated from the perspective of technology and product, because this is what we internally call the tech hedge, because it's something that should help us get us through, with our portfolio, get us through the economically challenging times as well, because that's the thing that really gives you a head start, and that's the thing that really is the basis to build a differentiable business model on top as well.
Fantastic. Mike, you helped us to also put this event together by spreading the word and inviting the right people, so a big thank you for that. I have to read this one because we found that on LinkedIn. You once wrote, "People love fruits, which are the dividends, but they forget how it all starts, which is the seed, or in your case, the seed money." Could you elaborate a bit more what you exactly mean by that?
Yeah, thanks, Silvan, for having me tonight. It's actually not difficult to find a quote from me on LinkedIn, because I hardly ever write anything on LinkedIn. So that was easy to find. Yeah, I see that on the startup level, but also in society, that we live in a society where self-service is like taken for granted. There's a machine for everything. People just go there, grab their food, grab their things. You see that on the society level. People go to the Bundesrat, they say, "I want more AHV." Everything is just a demand society, but nobody thinks about like the basic economies of life and of business. You cannot just ask for stuff. You also have to invest before anything goes. So the dividend is just like the end of the whole food chain. But we are all together here because we want to get something started. And we've seen exciting startups coming up with new ideas. And sometimes people think innovation belongs to big companies because they have a F&D budget and they do stuff. But it's actually not true. Very much the innovation comes from universities, from really energetic founders, and that's, I think, an idea that should be promoted much more in society. So people start thinking, where does it start? Not what can I take?
Someone has to put in the work to make that a reality. I want to do a quick round of questions for each and single one of you, just one sentence. The times are a bit more difficult these days to get funding from a startup perspective, right? There's uncertainty, interest rates rose. So I wonder, what are you investing in this very moment in 2024? Just one sentence. Let's start with Diego. What are you investing in 2024?
We are investing in stellar science and gene therapy.
Harald?
Still great teams and tech and product differentiated things. That just stays.
The fundamentals didn't change. Yeah.
Fundamentals are not changing yet.
Exactly. Kevin?
We look for teams with experience and industry knowledge and insights that can cleverly use the new technologies that are coming out and don't compete with the Magnificent Seven.
Yeah, we invest the same style that we have invested like 2 years ago, 3 years ago. European deep tech companies. That's where our competence is, and that's where we're investing. And we don't care so much about like these fluctuations.
You keep going.
Yeah.
And Diego, I want to talk to you about when is a startup actually ready for growth money? Because here we're focusing on the growth stage, but when are you actually ready to receive and potentially get growth funding as a startup?
Well, it's not an easy question. I don't know whether a startup will we ever be ready to get money. Because I think when you are investing during the dating. So you are in love with your company. When you start very, very quickly to understand that it takes much longer and costs much more than you have initially forecasted. But I think there is some landmark to see when a company is ready to start to get and search for money. Is first, I think, as Harald said, I think the team has to be sterile. Also, AAA is just the must. Yeah. The company has to really to invest also in a solution to a problem, not a problem looking for a solution. And third, it has to be. It may be not necessary to be a market there, because if you are investing in something which is new, you are creating that market. But it has to be a foreseeable plan to a potential exit. Whatever the exit is, it might be an acquisition, but it might be also a way to market your product. And there I am speaking now for non-healthcare companies.
I mean, that the path to exit, that's the contract that you make with your investor.
I think there are two elements. I think in the past, but basically the time and money to a foreseeable exit. And this is a very, very, how to say, a crystal ball exercise you have to do, but this is the exercise you need to do. And I would say there is not the right moment to go out to search for money. It's just the moment in which you are convinced you can get that money on board.
Kevin, you're reacting. I just want to see what you think.
No, I think it's all right. I think if you're in the growth stage, you found product market fit. I think if you're in growth stage, you're getting to or hitting the sort of 10 million ARR mark. It depends obviously on industry. I know very little about healthcare, but SaaS, if we talk SaaS companies, if you're looking for ARR, that's sort of a milestone. Everything is changing. AI is changing everything. So it really depends. If you do deep tech, it takes a bit longer. And growth has slowed significantly also in the public markets. So the big SaaS companies, growth has slowed. So pre the inflation recession we had, it was probably you're looking for really high growth numbers. And that has, in the public market, it has sort of halved by 50% and has slowed down, and that trickles down to venture investing as well. So anywhere 5 to 10 million ARR, you want to look at, if you're a SaaS company at NDR, you want to look at the burn multiple, and you want to have found product market fit. So you're looking to raise money to scale and conquer. And I think those are some key elements that still exist, and it's become a lot more difficult to raise that money. It takes longer. So we recommend really to take at least 6 months before you run out of money to start that discussion with VCs. And I think Emergence Capital came out with a report yesterday or 2 days ago, which had lots of benchmarks in it. So if you're a SaaS company, I'd recommend downloading that report. There's some interesting data nuggets in there.
Cool. Thank you for that recommendation. Harald, we hear some SaaS KPIs. What role does revenue play? Is that something that you look at before you even consider a growth investment?
It's good. I'm thankful that you brought that up and that Kevin was mentioning those revenue levels, because this is not what we're looking at. It might be because we're really coming from an early stage background and early stage history. There are probably two things that are interesting for us when we look at, let's say, the later stage. It all depends on what you call growth stage to begin with. Yeah. But I think you can look at the nature of the risk that you're taking. If you think about early stage, you're as an investor together with the founders and the team, you're actually taking a risk on a lot of things, right? You're taking a risk on the market, on the reception, on the customers, and so on. This should change as you go into growth stage. So the way we think about it is that it should be more of an execution risk than what you might call a venture risk, where you really build something and you don't know how the reception in the market is. So it's an execution risk, and with that, when it comes to readiness of investment, you really, again, I'm sounding like a broken record, but you need to look at the team, and when it comes to execution risk, how these people can execute and what the proof points are about the execution abilities of that team. And the other thing, the way you can look at it is, has this company established some form of leadership in maybe just a small market or just with their value proposition or just with their technology. But I think that's going into the direction of the product market fit. But if you can build upon such form of leadership, then it is for us something where we look at also from the growth perspective, I would say.
Got it. And Mike, next question to you. I know this heavily depends on the case, the industry that you're in, but if we talk about growth stage, what is sort of the range of funds that startups should aim to raise? Is it like at least 1 million or even more than that? What is sort of the range that you see in the market?
This growth is kind of an undefined term, right? It's really hard to say. But 1 million is probably not a growth stage funding. We're rather talking about 20 million or 30 million. That is really growth. But I think more interesting than that, what is the amount that you're raising is like, which stage are you in? So I would like broadly distinguish between two stages. Stage one is, I call that innocence and hope, because then you're still innocent because you have never seen a client. And there is a potential that somebody acquires you because he has hope that once you have your product hitting the market, that this will succeed. But then once you have, make progress and come to stage two, you are in the business, really active clients. And then I think in many cases you start from scratch again, because then you hit the real market, then you need to have a sales team and all that comes with a normal business. Mm-hmm. And then you lose your innocence and maybe also it's no longer so much hope from the investor, but because he can see the clear figures.
Yeah. Got it. That's actually super useful what you just shared. Thank you for that. Kevin, I also wonder, you've been a founder yourself. You mentioned the importance of the team, but what else convinces you to then go into a growth stage investment? Because the team probably is still very important, but maybe even a bit less important than in the early days where you solely bet on the team.
Sure. So again, I agree. I look at growth stages, sort of 20 to 30 million and up financing rounds. And you have a lot more data to go on. So while you also do a lot of pre-seed and seed, where there is a lot more venture risk, when you come to growth stage, you can talk a lot to clients. You can do reference calls. You can try to analyze and identify that leadership in that category, in that niche where they started off, in that Normandy Beach where the company maybe started to acquire customers. And then you have benchmarks and you compare them across other companies that you see. And founders should never forget that. And you don't operate in a vacuum and there's an opportunity cost every time you come to pitch. And when you're in the growth stage, we compare burn multiple, we compare how you have used capital efficiently, and you can make mistakes. You got to just explain the mistakes. You got to explain what you learned. But we compare capital efficiency. We compare how much do you upsell versus how much are you acquiring new clients? What's churn looking like? And again, it's different from industry to industry, but we compare that within our industries and benchmark it. And then obviously we're really interested in the team and how are they planning to take this forward and conquer and be really ambitious and have a global outlook of becoming very, very big. The outcome needs to be tremendously big. And we also depend on later follow-on financing, which often comes from the US. And the big American funds, they need tremendously big outcomes, which is often a challenge. So the TAM and the market needs to be huge and it needs to be growing, because growing markets, all boats rise up. So that's another thing, that even if the company and the founders are really interesting, but the market is not growing, I don't want to say it's a red flag, but it's certainly a big concern.
That's like a big leverage that you can use as a founding team or as a company.
Right. It allows you to make mistakes and yet still continue growing. Right. It's really important.
One important aspect, Mike, is also how much shares you give away in a round, right? What is sort of the range there that you see happening in growth rounds to get enough return for you as an investor, but to also, from a founder perspective, not get diluted too much?
Yeah, if we take like a typical growth fund, take 20 to 30 million we just raised, typically as a founder, once you got there, you have to expect to lose like 25% or more, because most founders are cash poor, and so they cannot reinvest with the round. And then I think it's really a matter of the board and the investors to say, make an assessment: is this founding team still like really into the game, and does it have like skin in the game in terms of shares, or should you compensate that with an ESOP to give them more shares after the dilution? I think that's an important factor to consider. But also the founders need to make their calculation. How much do I need through the next couple of years? And there's so many tools out there these days that you should be informed how this works.
And as Diego mentioned at the beginning, probably more than you think at the beginning.
It's always longer and more.
Exactly. And Diego, once you close a deal, you invest in a startup in the growth round. How do you then collaborate and work with them? Do you always ask for a board seat, or how does that collaboration work after the investment?
I think we are defining ourselves as active investors, and basically mean that we are very close to the company, providing also not only money, but what we are saying also smart money, and being present in the board or as an observer. It does not mean micromanagement or research management. I think the entry points to the company are the chairman or the CEO. It's never the approach to go to talk directly to the CSO or to somebody else in the company, but just to follow the company very, very closely, also in between regular interactions like the board meetings are. This is how we are working. But maybe if I may allow just a comment on the valuation, say before, I think, to me, I think as a founder, you should not care about valuation of your company. When you are looking for money, what you should care is what will be the potential value of your company at exit, and then to make the calculation backwards.
So you're basically saying making the pie bigger than
I give you a very
thinking.
clear, a very simple example. Everybody knows Moderna. Okay? Moderna went IPO with 900 million cash in the bank. Nonsense. It's a nonsense to come on. You know why they went IPO? Because the CEO had on the top of his common shares 6 billion of liquidation preferences in case of a trade sale. That's the reason why it was IPO.
Talking about incentives.
So, you see, this is really, it's just whether you are owning 1, 2, 5, 10%, who cares? If you're owning 25% with a very complicated cap table in which you have the preferred shares, we have 3-4 times the liquidation preferences, it's better to own 2% on a common shares with all classes of shares equally treated.
Absolutely. And I think that's something that often founders, at least from my experience, from my conversations, don't think until they walk through that, the importance of the incentivization, of having everyone aligned in the same direction. There's one last part I want to talk about to you, Harald. It's about getting in touch with investors. Many startups here are pitching to get visibility, to make these connections, but what would your recommendation be to actually reach out to potential growth investors?
That's a very tricky one. The thing is that you have a lot of visibility at the later stage. It's a very different game from the early stage, right? Where you know there's a lot of the information is not that transparent. But once you're in the growth stage, you have a track record, and I would almost say that if you got good investors, will find you. I will say that because they are very, very, very active. The good investors really have an aim. They want to see each and every single one of the potential companies at the growth stage, I would say. So it's almost a due diligence that you can do on your investors, whether you had to approach them or whether they approached you. But I really think there's a lot of transparency at that stage, a lot of information available, and you know it's at that stage. It's really about investors being proactive. And being visible. Maybe that's one thing, to have an effort to being visible, but in a good way, right? You have to be active in your field, and then being on the radar and coming on the radar of the investors.
It's a bit like Y Combinator in the early days, build something people want, and then at the growth stages, build something of value that investors want to get a foot in the door, basically. I love that. It's a bit counterintuitive. We could go on for another hour easily, but I'm going to save that for the apero. I'm sure the audience will also want to grab you for a drink or a pizza or something to ask you a few more questions. Mike, Kevin, Harald, and Diego, thank you so much for being here today. A big round of applause, and we have a little present for you at the end. Please give it up for them.
Thank you very much. Thank you.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.